Welcome, everyone, to MMP's update of what 2020 looked like, a very different tax year, and what we could expect in 2021. Thank you all for joining us today. Let's get right into it. This year has been challenging for sure in 2020, and 2021 looks to be a further challenging year as we look across the country. And as we look back and look forward, it's good to take stock of where we are today. As we all know, the pandemic continues to be present across the country. Variants are emerging constantly. It's impacted the economy, businesses, and especially families. The government introduced several relief programs, and for those of you that are fans of Sesame Street, they're brought to you by the letter C: CERS, CEWS, CEBA, CRB, SECRA, and various others. 2020 was the first year that the budget was delayed that I can remember, and it was postponed due to COVID-19. The government did, however, deliver a fall economic statement in November to address the ongoing effects of the pandemic and provided some additional measures and insight, which we're going to talk about in the upcoming slides. As I mentioned, cases continue to rise, new variants are emerging, and the vaccine rollout has proven to be a challenge. Note that pre-budget consultations are underway. We are expecting a budget this year, and MMP has been actively involved for our clients in those discussions, and we'll be making submissions to the federal government. What has been the response to date? Well, the government response has supported the economy in many forms, as I mentioned. However, this deficit that we're dealing with is the largest since the world wars. The fall economic statement that was delivered in November projected a deficit of $381 billion for 2021 and material deficits for each of the next 5 years. So the question is, how will we recover? How will we recoup this? And that's what a lot of our clients have been asking us. The 2020 fall economic statement did provide an update on the finances of the government, but it also brought about some specific measures that they introduced. One of the measures that they spoke of was audit activity. They promised $606 million in funding for international tax evasion, aggressive tax avoidance, and high net worth individuals. And since 2016 alone, the government has committed $350 million per year on an ongoing basis to the CRA to crack down on tax evasion and combat aggressive tax avoidance. So the government is taking seriously the implications of people trying to move money offshore and avoid paying their taxes. The other measure that the government introduced in the economic statement was employee stock options. These employee stock options have always had favorable tax treatment because it's been a tool for companies to attract talent to their organizations. The tax preferred treatment, provided conditions were met, allowed these stock option benefits to be taxed as though it was a capital gain. However, the government sees or perceives that these have been used too widely and in the wrong context. Therefore, they're going to start limiting stock option benefits to $200,000 annually per person. However, it will not apply to CCPCs, early stage companies, and companies whose revenues are under $500 million. These changes will be beneficial to those companies because it will continue to allow them to attract talent. And please note that these will only apply to stock options granted on or after July 1st, 2021. So there is still a window of opportunity for you to implement one of these stock options for your company. The other item that was discussed and brought forth is relating to sales tax. I like to refer to this as the quote unquote Amazon tax. Fulfillment warehouses, it was unclear previously who was to be collecting the tax for online platforms that were fulfilled by warehouses in Canada. These changes target the operators, i.e. the one that operates the warehouse, and the government is proposing that all these fulfillment warehouses be registered and collect the tax on goods that are being shipped from a Canadian warehouse, to the extent that the vendor is not otherwise collecting the tax. So this levels the playing field to some degree where the tax is going to be charged. The other tax that they brought in was a tax on digital supplies made by non-residents directly to consumers. I like to refer to this as the Netflix tax. They're proposing changes to the application of the GST-HST to these digital supplies, because currently, if a business only has a digital footprint in Canada, they're not required to register and collect and remit HST or GST. They're proposing a simplified registration for the non-residents to bring them into the GST system, and these rules apply to business to consumer transactions. Under this new system, non-residents will not be eligible to claim input tax credits, and this follows some of the rules that were already been implemented by some of the provinces. Sticking with the sales tax theme for a moment, they're also introducing an online short-term rental tax. I like to colloquially refer to this as the Airbnb tax. So now there's going to be a framework for non-resident accommodation platform operators that are not otherwise carrying on a business to Canada would be required to account for HST on short-term supplies of accommodation. And so this could be complicated in terms of those people that are using their property as an Airbnb. And finally, the government is also going to look at introducing a tax where there's unproductive use of domestic homes owned by non-residents. And so they feel that these rental properties are being sitting and being unproductive. And no definition of unproductive was provided, but it's looking to tax these homes that are sitting vacant, owned by non-residents, similar to speculation taxes that have been introduced provincially in other areas. And finally, the government advised that it's going to launch consultations on modernizing some of the anti-avoidance rules that are already in place. So lots of sweeping changes in various sectors depending on where you operate, and more probably to come in the budget that we're anticipating this spring. So what is next? What are we anticipating in the upcoming budget? Well, some of the indicators came from the throne speech when the Liberals recalled Parliament last fall. They indicated as to looking into and identifying ways to tax extreme wealth inequality. And in that, they mentioned limiting the stock option deduction, which they subsequently did in the fall economic statement. And also addressing corporate tax avoidance by digital giants, which they again did. So they're making good on their indicators in the throne speech. But what else did they mean by extreme wealth inequality and making sure that they equalize it? Well, there has been much speculation and political discussion about a potential introduction of a wealth tax. You know, there was a formal motion to introduce a 1% wealth tax over 20 million, but it was voted against by the majority last fall. But that doesn't necessarily mean that the idea is dead. There were numerous countries that tried it, G7 countries for that matter, Germany, France, Sweden, France being the last one that repealed it in 2017. Today, there only remain 4 countries that have a wealth tax: Spain, Norway, Switzerland, and Belgium. Now, the wealth tax, when you look at it, the reasons that they were abandoned was because it was extremely complex because of valuation and how do you enforce compliance. In Sweden, for example, the founder of IKEA left Sweden and all of the capital exited until Sweden repealed his wealth tax, and then he returned. The wealth tax was also the subject of a parliamentary budget office study. In that, they projected that if they put a 1% wealth tax on the net assets, so assets minus liabilities of families over $20 million, so net worth over $20 million, that would raise $5.6 billion and impact approximately 14,000 families across Canada. If you recall, the projected deficit is $380 billion. So wealth tax alone is not going to recoup the deficit that's created. The other question that's often discussed is whether or not there's going to be a change to the capital gains rates. There's much speculation that this could change possibly back up to 75%, as that was where it was from 1990 to 2000. This change would reduce the disparity between capital gains rates and dividend rates. Note that capital gains sometimes are often associated with wealthy, or those people that can afford to invest in the stock market or can afford to have a portfolio of investments. So this would be a change that could be put out there by the government. Sales tax is another area that the government has the ability to modify. From inception on Jan 1, 1991 to 2006, the GST rate was 7%. Now, subsequently, it's been reduced to 5%. So taken together, these rates are lower than the average standard rates reported by the OECD. So out of the 35 countries the OECD recorded an average standard VAT rate or sales tax rate of nearly 20%. Now, many economists believe that consumption-based taxes are the most efficient taxes, while others note that they disproportionately hurt lower income earners. So increasing this GST rate has always been an option to present it to the government, and an increase from 5% to 7%, along with a 40% increase to the GST credit, would raise nearly $15 billion annually, according to a C.D. Howe Institute study. So the government can use this as an option, but again, understanding that it would hurt lower income families. Corporate tax rate increases are another topic of discussion. These rates are the lowest they've been in 25 years. They were about 43% back in 1995. And right now they're sitting at about 27% in 2020, assuming you don't have the small business deduction. Personal tax rates have increased significantly during that same time period. When we look south of the border, President Joe Biden's campaign was on an increase to tax rates down south to 28%, plus a corporate minimum tax of 15%. So if rates are going to go up, it also gives Canada the ability to raise rates and still be competitive. So they'll be watching that closely. And finally, what are other revenue-raising measures that they could implement? And one of the things that they're trying to do is gather information on where they could implement new taxing situations. And that's led to more disclosure and the CRA's focus on disclosure. There are new trust reporting rules that are coming in. The primary purpose is, they say, is to increase the transparency of the ownership and help assess the liability for trusts and beneficiaries. So effective this year, meaning taxation years ending on or after December 31, 2021, there are going to be many more trusts that are going to require to be filed. Before, you would be exempt for various reasons, but now, if you have assets less than 50K throughout the year, you could be exempted, but the number of exemptions has significantly decreased. And the new reporting requirements are quite onerous as well. For example, it includes reporting the name, address, date of birth, jurisdiction of residence, and tax identification number for each trustee, beneficiary, settlor, and what is also referred to as a protector of the trust. There's lots more disclosure that needs to go with this. So be aware that these increased disclosures will be required during the year, and the government continues to collect information on taxpayers, and specifically has started in this year with trusts. The other disclosure that they're looking to increase or get more information on are companies that have foreign affiliates, or if you own a foreign company overseas, depending upon your ownership stake. This disclosure has been increased significantly in terms of what is required. The information is already several pages long, but it's going to grow exponentially with this new form that's coming out. This is going to be for taxation or fiscal periods that begin after 2020. So it's not yet in effect for some, but it will be. Now, just be aware as well that you have to gather this information relating to foreign entities, and at the same time, they're accelerating the filing deadline to 10 months when it was previously 15 months. That could be difficult for some countries overseas, allow people to file or corporations to file their return more than a year or a year after. So you're going to be filing information potentially that's draft. So it will pose challenges. Again, more disclosure and what we refer to as the Schedule 50 campaign at MMP here. The CRA has contacted us numerous times and our clients to make sure that the shareholder information disclosed on the tax return is accurate, that it meets the corporate registry. So making sure that that is the case so they can track who are the owners and what associated groups perhaps they're owners with. So this massive data gathering exercise is already underway. The other area that CRA is going to take a renewed focus in is compliance and enforcement. Due to the pandemic, the CRA's activity was initially halted. At the beginning of October, many CRA services have resumed, including reviews of objections of applications for taxpayer relief, high dollar audits, audits close to completion or have strategic importance, and audits in the real estate sector, audits of complex, aggressive tax planning using partnerships and trusts, and ongoing charity audits and revocations. So as these continue to resume, we expect to see focus on the following. CEWS audits. During the first period of CEWS, the CRA was undertaking pre-payment verification. But in the summer, the CRA confirmed that it would also be piloting a CEWS post-payment compliance project, in which it would audit statistically valid sample of corporate CEWS applicants. We understand that the intended goal of these audits is to gather information which will inform the scope of future large-scale audits of CEWS applications. We began seeing the first post-payment audit of CEWS applications in September. Our initial observations with respect to these audits are that they are a cross between a full revenue and a full payroll audit. The questionnaire has evolved over time and is likely to continue to evolve as CRA gathers information and experience auditing CEWS, but clients could be overwhelmed at first glance by the detail and number of questions being asked. MMP can play an important role guiding you through this process, so just be aware that the claim was filed, we had the information, and then you had the information. So although the CRA is looking at it, they're just validating, and we should make sure that we validate and give them the right information. The other area that we know that's going to be resumed is net worth audits or related party audits. This initiative was launched a few years ago and remains a key priority. Per the CRA, wealthy individuals use private companies, complex schemes, including complex offshore strategies and structures. So they introduced a risk assessment and additional audit teams to address non-compliance amongst these taxpayers. In its most recent department plan, the CRA indicated that it would continue to target non-compliance amongst high net worth clients and their related entities, and those that enable tax avoidance by risk assessing that population and conducting audits. By March 2021, the CRA intended to refine, add, and automate algorithms to improve the risk assessment of high net worth individuals and their related economic entities. Again, using the data that they've collected and expanding the data that they're collecting, they're looking to be more automated in targeting these audits. Real estate transactions are also an area that the CRA is looking at, especially in Ontario and BC. Since 2015, CRA audits have identified over $1 billion in additional gross taxes related to the real estate sector. During this period, the CRA auditors reviewed over 41,000 files in Ontario and BC, resulting in over $100 million in assessed penalties. So be aware that they're continuing to chase this and they're issuing unnamed persons requirements to property developers, builders to gather information about buyers involved. So the questionnaires can be significantly detailed. 35 questions or so, requests for numerous documentation. So be aware that these are continuing and ongoing. Trust audits are another area that started a few years ago and is continued. They're focusing on trusts under which beneficiaries claimed capital gains exemptions, including lengthy questionnaires tracing back to how was the trust established, the subscription of the shares, and the amounts that were payable to the beneficiaries. We only expect audit activity to increase in the upcoming years, especially when you look back to how much the government has committed and promised to commit in the fall economic statement to furthering compliance and enforcement. But it's not all bad. What can we do? What can we do now in the areas that we are in and in the situation that we're in? Some of the things we could do was undertake some planning to help ease the tax burden, potentially planning that the burden would be coming in the future through some of the increased rates or some of the increased programs that we spoke of earlier. One of the items that we can do is an estate freeze or a refreeze. This is a very common planning technique that can achieve both tax and non-related tax goals. Because of the pandemic, values of businesses may be depressed, and it might be an opportune time to introduce new family members or family trusts for that matter into the ownership structure. If you've already done a freeze, then you could consider, has the value declined such that a refreeze is an option? And by doing that, both an estate freeze or a refreeze, what you're doing is freezing the value at a lower value to the principal shareholder, allowing for more growth to pass to the future generations. This also limits the tax liability of the principal or the current shareholders upon their passing, and allows for a more effective transition of the business and wealth to the next generation. The other aspect of a freeze may be to move excess corporate assets to a holding corporation, or to keep the corporation clean to claim the enhanced capital gains exemption, or the QSBC. Family trusts play an important role when evaluating whether or not they should be introduced for non-tax reasons, and even in the era of the income splitting or TOSI legislation, because the capital gains exemption is still in play. If shares are disposed of and you meet the QSBC test, family members can still be allocated capital gains, thus multiplying your capital gains exemption, which sits at roughly $890,000 for all family members, including minors, provided you're selling to an arm's length party. So you need to explain this specifics to the beneficiaries, but again, freezing and putting in place a transition plan could be a good time given values where they are today, and that they could be lower than in a non-pandemic economy. So that once this economy does recover, it's putting the growth in the hands of the next generation. The pandemic and the economy has also brought about operating losses for companies. So one of the things that can be done is to use those operating losses and carry them back and file your tax return as quickly as possible to recover those taxes that you've paid from prior years, helping the cash flow of your business. In addition, when you look at the cash flow or you look at the company, one company may have a loss, the other company may have profits. How do you offset the two? Looking at strategies to either combine those companies through an amalgamation, such that you use the losses of one to offset the profits of the other, or using other techniques of transferring the losses from one company to another, and thereby monetizing those losses, bringing cash back or minimizing the taxes that you have to pay, are strategies that should be considered, taking advantage of the downturn in the economy. Another situation that could be looked at is potentially reorganizing your corporate assets. This can achieve many objectives, including minimizing risks to the asset and creditor proofing. If you had, for example, a real estate portfolio or a real estate asset in a profitable company, you could transfer it to a loss company, thereby removing that asset from the operations and securing it effectively or creditor proofing it. Once the asset is in the loss company, it could lease it back to the profitable company. That profitable company now gets a deduction from its income to transfer that income to the loss company through a lease payment. That loss company had losses, so that income is sheltered, and overall the tax burden of the group has decreased. We've talked about potential increase in capital gains rates. Something to consider is whether you should trigger capital gains now in anticipation of the rate going up. That's a decision that everyone needs to make themselves, depending upon their risk tolerance. But another method would be to, if you are taking out dividends, looking at whether or not there's an ability to realize gains on the assets or realize gains on the shares that you own and be able to take out some of your value in that manner. This would provide a significant benefit. In some instances, the differential between realizing a capital gain or receiving a dividend is about 20%. 20% guaranteed return in savings. And this potential plan could be reduced in budget 2021 if the capital gains rate changes or if they introduce specific legislation to prevent us from doing that. So speak to your advisor as to whether or not this would be something that would be beneficial for you. On the flip side of triggering gains is triggering losses. If you have stocks that are depressed or assets that are depressed, you could trigger a capital loss and carry that loss back to the prior 3 years if you had realized capital gains in those prior 3 years. That would recoup the taxes that you'd previously paid and bring cash back into your hands. The other situation that you could think of is what we call the winners and losers strategy. If you had a portfolio inside a corporation, you could sell your winners, realize a capital gain. That gives you this wonderful thing called a capital dividend account that can come out tax-free. You pull out the capital dividend account, take the money tax-free, and then you sell your losers in the portfolio in the corporation. You plan so that your gains offset your losses and you have no net tax in the company. However, you've achieved an extraction of tax-free cash by employing this strategy. Just something to be aware of. The other item people should take advantage of in this time frame is prescribed rate loans. Currently, the prescribed rate sits at 1%, and it's the lowest it has been in a long time. One of the strategies to do with a prescribed rate loan is to lend money to your spouse. Once you've lent the money to your spouse, they invest that money, and any income that's earned is then taxed in their hands. Assuming that they are the lower income bracket, that income is not coming to the high rate taxpayer, but being taxed at a lower amount. The criteria is that you have to make sure that you pay that interest by January 30th of the following year. If you don't, unfortunately, the whole plan does unravel, but it's a very simple and effective means of putting income that would otherwise be earned by a higher rate taxpayer into the hands of their lower income spouse. You can also look at this with family trust. There are opportunities to make prescribed rate loans to a family trust and not only allow that income to be taxed in the spouse's hands, but also in other beneficiaries' hands. There are several conditions to meet with regards to this, so speak to your M&P advisor if that particular situation appeals to you. And finally, we'll talk about philanthropic planning and will planning. it's always a good time to revisit the terms of your will or an overall estate plan to make sure that it meets your objectives and the changing circumstances. This should occur alongside other tax planning or transactions and considerations. Cash, in-kind gifts, or the potential of establishing a private foundation may be considered in isolation, but it can also provide tax efficiencies when considered in conjunction with planning for an upcoming sale or reorganization, or as part of your overall estate plan. So with that, we've covered where we think we're headed, some of the things we think that are coming along, and what opportunities currently exist for you. This pandemic is certainly unprecedented, and it's given us uncertainty and continues to give us uncertainty as we look forward. However, we hope that Budget 2021 is going to give us some insight into where the economy and the finances stand of this government, and potentially it may close some opportunities for us on planning that we've touched on in this presentation. So while there is some downturn and understandably some hardship, there may be some opportunities for you to consider and think about at the same time. In order to keep up to date, please make sure to check out our COVID-19 Advice Center and website and sign up for any updates as well that will be delivered directly to you. And finally, please speak to one of your M&P local advisors if you have any questions on this presentation. Thank you and have a great day.